Get Rich Education is brought to you by Norada Real Estate, Mid-South Homebuyers, and Ridge Lending Group.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, welcome to Get Rich Education, episode 154. I'm your host, Keith Weinhold, and I am in San Jose, Costa Rica today. We're talking with a nationally renowned mortgage loan officer here on how you can get the best income property loan for yourself. I am sure that you've already heard of her. I'm pretty excited that she is going to tell us about specialty loan products beyond your first-hand income property loans. After you've already got your first-hand Fannie Freddie loans maxed out, what do you do next? I think you're going to be more excited about your options than ever. But first, let's increase your cash-on-cash return right now. When you write an offer on an income property, try to get the seller to participate in some of your buyer-side closing costs for you. Now, the most that you can get is 2% of the purchase price as that seller concession toward your closing costs. This might be how something like that works, okay? On a property with an asking price of $100,000, you might say, hey, Mrs. or Mr. Seller, I'll give you your $100K and I'd like for you to pay $2K toward my closing costs because that's the maximum that you're allowed to get. And if they say yes, that's great. But if the seller says no, because that way they would only get $98K, then what you can do instead, if they say no to that offer, is to offer them more than the asking price. You can offer $102K and that you'd like $2,000 back in closing cost help. That way, the seller still gets their $100K and you've reduced your cash out of your pocket to close. If you're successful in doing this, your loan amount is now $2,000 higher, and you can effectively get the lender to give you a long-term 30-year fixed interest rate loan on that extra $2,000 that you saved from coming out of your pocket. So now your mortgage payment will be just $11 higher every month at today's interest rates. So that's only an $11 per month drag on your cash flow, yet you have $2,000 less of your money out of pocket, and that's how you get ahead on a cash-on-cash return basis. Understand that the property, now, it will need to appraise for $102,000 rather than $100,000. So that's one risk that you take with that strategy. You need to get that higher appraisal. And your appraiser is going to see that that $2,000 seller concession is in there, that it is in the purchase and sale contract, which just made your offer price tick up by 2%. So yeah, those appraisers do see that prior to performing their appraisal. Now, sometimes sellers and others in the deal, when I've done this myself, they think, oh, well, maybe I don't have enough cash to close, and that's the reason that I want to structure things this way as a buyer. And, that's up to them to think what they want, but it gives me a better cash-on-cash return. In fact, the first turnkey property that I ever bought, which was 5-6 years ago in Texas, that was structured similarly. Now, in addition to your down payment, what about those closing costs for your income property? They vary fairly widely. They're going to vary based on that state that you're buying your property in, of course. They're usually between 3 and 5%, and sometimes they can be more than 5%. Among the higher closing cost states are Texas, Florida, a number of the northeastern states. Some states just have different things. Pennsylvania has that pesky property transfer tax if you're buying there. So reduce that 3 to 5% plus upfront drag by asking for a seller concession if your provider finds it appropriate. Ridge Lending Group is used to having buyers in almost every U.S. state, and they'll always present you with a conservative quote via their fee sheet. That is sort of your first look. Ridge sort of came on my radar because I learned a while ago that they specialize in income property and that they're in almost every U.S. state. So they just know how to deal with some of these things and work with many states' nuances, like, for example, that transfer tax in Pennsylvania. Let's hear about the latest on the income property mortgage loan climate today. Today's guest is the president and CEO of Ridge Lending Group, and she's a fellow real estate investor. She has spent the last 18 years as a nationwide lender, loan officer, and real estate investor, and she's loaned for both residential and commercial. So as an investor herself, she has held dozens of investment properties at any one time across the United States, so she really knows what kind of loan you need as an investor herself. Income property loans are exactly what her firm specializes in. She has worked with tens of thousands of real estate investors and homeowners all over the country, and at this point, she has helped more families realize their dreams of home ownership as real estate investors than any other mortgage lender in the country. She maintains and serves her real estate investor database of 60,000 strong and growing. Welcome back to Get Rich Education, Caeli Ridge.
Thank you so much, Keith. I am very excited to be here with you today. I've got a lot of good information to share, I think.
Caeli, you were last here with us over a year ago, and mortgage loan guidelines and rules have this big delta. They're one of the more dynamic and changing parts of this whole real estate investing industry. So just something for the listeners, if you're listening to this a few years down the road, things have probably changed. So this is kind of more contemporaneous information. And I want to emphasize that we're talking about income property loans, not properties that you're going to live in, not owner-occupied properties. And we're talking about those conventional loans, those ones where you can get the very best rates and terms on 1 to 4 unit properties, single-family homes, duplexes, triplexes, and fourplexes. So, Caeli, the last time that you were here, an individual could go ahead and qualify to buy 10 income properties for just 20% down payments on each one of those, up to 10.
That is still accurate. There's been a few updates and changes to the guidelines. I mean, a lot of people, conventionally speaking, will equate the seller's guide, which is what we live by, to resell a conventional loan as a moving target. We try to keep up the best that we can to maintain all of those changes in the industry. So if I can, Keith, why don't I just share some of the most prominent of those changes for your listeners?
Please.
Okay. Debt to income ratio has changed slightly. 50% has always kind of been the threshold, but prior to the most recent change, at 50% debt to income, we needed the buyer or the borrower to be able to provide compensating factors. So if you had a 50% debt to income ratio, you needed to be able to show strong credit or assets in that example. Now it is just a straight 50%, and those compensating factors are no longer required. So that was kind of a boon for us.
A loosening.
Yeah, a little loosening, right? It tends to seem like in this industry, the loosening of those purse strings is usually, 2 steps forward and 3 steps back, but we'll take it when we can get it. So I'm not complaining, but that's typically the case. One of the other primary changes most recently is for LLCs. For investors that use LLCs for asset protection, which, most of us do, when we're talking about a cash out refinance of an investment property in a conventional loan, you are now required to hold that property in the individual name for a full 6 months before the property is eligible for that cash out refinance. It used to be that you could quit claim out of the LLC back into the individual name within the refinance transaction. We've heard some grumblings about this over the last year or two, but it is now official and across the board. You will not be able to do a cash out refinance on that investment property until you've held the title in your individual name for a full 6 months. So there's that 3 steps back that I was kind of mentioning. You get a little something and they take a little something away. So I would say those are the 2 primary changes to the conventional loans that I think would be most important to your listeners.
Okay, no more flash quit claiming.
Now that's for a cash out refi. Let me also clarify. If the individual is doing a rate and term refi, whereby they're just wanting to exchange their existing loan for a new loan, right? There's some benefit, lower interest rate. Maybe they're taking an ARM and putting it into a fixed. There's some tangible benefit there. The rate and term does not impose that same restriction. It is exclusively for the cash out refinance that restriction exists now.
Yeah, Caeli, so I often wonder what prompts some of these changes in these requirements. Why would there need to be a 6-month quote-unquote seasoning added?
It's a good question. I'm not sure I've got a good answer. In this case, I think that it is from business purpose loan and making it more individual. That's probably the only legitimate response that I have. Fannie and Freddie, as most of us know, do not lend to entities. They will only lend to the individual. And further, at closing anyway, they do not allow an individual to close the title ownership in an entity. So although it's very commonly done in the industry for investor financing, it's just one of the pushbacks that Fannie has been putting out there. And on a cash out, it's what we're being told we have to live by now.
So definitely a longer-term planning consideration there. So apparently then, since you were last here, there haven't been any changes. A husband and a wife still can qualify for a total of 20 finance properties. One of those, though, if that's their primary residence, it's only 19 more together that they could qualify for. And just to give the listener an idea, if you have 19 income properties and they all cash flow $200 each, that's $3,800 per month. Or if they cash flow $300 each, that's $5,700 per month if you go ahead and get 19 income properties as a husband and wife in addition to your primary residence. So this is just the kind of impact it can have on your life. And that doesn't include your other loan types or any apartment buildings or anything else that you might own. And also for preparation, I think we discussed last time, Caeli, how the earnest money deposit and the down payment, that had to be liquid funds. It could not be a gift, and it needed to be sourced in season for, was it 2 months?
That's correct. Yes, 60 days. So the bank statements that we will receive from our clients need to be able to show those liquid funds as originated with the individual. So if there are large deposits listed or shown in either of the bank statements that they've supplied us, we'll need to be able to go back and say, okay, where did this come from? And with a simple paper trail, we can prove that it's originated with the individual, and that's perfectly fine. An example of what does not work, and the story that I'll give is if Great Aunt Sally says, here you go, Keith, here's $50,000 to invest in real estate, well, that's fantastic. Until Great Aunt Sally's $50,000 has sat in the individual's bank account for a full 60 days to where the deposit no longer shows and only the balance, it will not be admissible until that time has passed.
Okay, another long-term planning consideration. And then with the reserve requirements, that's a component that may be illiquid. Tell us about the reserve requirements, again, for just conventionally financed properties here.
Yeah, the easy formula for reserve, well, it can be in either liquid or non-liquid form. Non-liquid form is going to be the retirement funds. Those will be your 401ks, your self-directed IRAs, whole life insurance policies, things of that nature. And those are perfectly acceptable to satisfy the reserve requirement. Why don't I go through and just kind of briefly outline what the requirement is while we're talking about it? So people are unaware that there is 2 separate underwriting books, if you will, depending on how many financed properties an individual has. So the 10 golden tickets, as we like to call them, there is one set of guidelines and underwriting criteria that is applicable to loans 1 through 6. And then there is a second new set of guidelines or underwriting criteria that applies to 7 through 10. So as this applies to our reserve question, in loan spots 1 through 6, the reserve requirement, just an easy way to outline, we need to be able to show 6 months worth of PITI, that's principal interest, taxes, and insurance, HOA as well if it applies, but 6 months PITI on the subject property, that's the property that is in focal point or in question in underwriting, plus an additional 2 months of PITI in each subsequent rental property spot. For example, let's say you've got your primary residence and you're at your 6th conventional loan.
Okay.
In that case, we're going to want to see 6 months PITI for that 6th property plus an additional 2 months PITI for properties 5, 4, 3, and 2. Property 1, of course, is considered the primary, and that does not count in this calculation, only the rentals. Now, when we move into the 7 through 10, the guideline changes. They sort of raise the qualification bar. It now becomes 6 months PITI for all rental properties. You know, when I say that out loud, some people tend to kind of think that's going to be a huge number. But to quickly put it into perspective, let's say that the individual is at their 10th property. And let's say that every one of their rentals is a twin. They're identical to one another. And let's also say that the PITI of these properties is $650 a month. So that example, we would take $650 a month times 6 months times 9 properties The reserve requirement in that example would be just roughly $35,000. And again, it can be in liquid or non-liquid form. So your 401ks and things of that nature are perfectly acceptable to satisfy the condition of reserves.
Okay, $35,000 might sound substantial until one considers that they can use a portion of retirement funds if need be to satisfy that reserve requirement.
Correct.
What about interest rates? Typically, interest rates are, about 0.5% higher for these non-owner occupied income property loans than they are for primary residences?
I guess that's a fair assessment. There's a whole variety of variables that go into an actual interest rate when locking in a rate for a property. There's a matrix actually on a rate sheet. And within this matrix, there are pluses and minuses. Specific to investment properties, these pluses and minuses are going to be things like credit score, loan size, loan to value, property type, occupancy, obviously, to your point, owner occupied versus non-owner occupied. All of these different variables will play a role. So the difference can be 0.5 point up to 1.5% from an owner occupied to a non-owner occupied. Baseline for interest rates today on a 30-year fixed mortgage with 20% down, single family residence, loan size 100,000. Rates are posting at about 4.125 to 4.25, so they are fantastic. We've seen them actually come down slightly over the last couple of months.
That is just amazing. Still here in late 2017 that interest rates are that low for a property that you don't even intend to occupy, because basically the short story is banks go ahead and put risk premiums on income property loans because it's easier for a borrower to want to default and walk away from an income property if they absolutely had to than the roof over their own head in a primary residence. Yeah, the opportunity continues to be terrific. So for new purchases, we can still get very low interest rates. And we've had such a buildup of appreciation that people are more inclined to want to do 1031 exchanges and cash out refinances. Let's just talk a little bit more about a cash out refinance. What are the loan to value thresholds for getting cash out of a primary residence and getting cash out of income properties?
Well, depending on the loan size, a primary residence, typically you'll find that 80% is going to be the threshold. Most people want to avoid that PMI, private mortgage insurance. So anything over 80% on a primary is going to carry that private mortgage insurance. And then again, to loan size, there's some restrictions there too. So owner occupied, I'd say 80% is roughly the threshold. You might find a 90% out there. Non-owner occupied, you can expect 75% leverage on a cash out refinance of a single family residence and 70% loan to value on a 2 to 4 unit property.
Now, there are so many different types of cash-out refinances. Should one go ahead and take out an entirely new loan, or should they take out a HELOC second? And, of course, there are more it-depends factors around that. But, what are your thoughts in today's environment versus when someone wants to take cash out of a property, just refinancing the entire thing in one loan or pulling off a HELOC, home equity line of credit, second?
You're right. I think that there's some very specific questions I would ask an individual first before I'd be able to answer that with any certainty, depending on what their current loan position was. What's the interest rate that they're currently paying? Can we save in the interest rate by doing a straight cash out on the first lien mortgage? If that's the case, I think typically I would say, a straight cash out, reducing the current interest rate and then pulling the cash that way. I like the idea of a HELOC. However, on an investment property, I don't know that that is a tangible market loan program that they're going to find. There may be some local area banks to where the property is located that might be willing to take a second lien position in HELOC form against an investment property. If any of your listeners know of such an animal, I would be very interested in hearing about it. We don't have access to that, and I don't know who does. Now, on a primary residence, chances are the HELOC works very well. I like the idea of having a line of credit that can be drawn on as needed. You're only paying for what you're using. So I love that philosophy. The downside, obviously, if I'm going to play devil's advocate with this, is that the home equity line of credit is variable and it's interest only. So, I think it's specific and subjective to the individual's qualifications and their overall needs. I think, though, that those are just some baseline yeses and nos between the two.
With HELOCs, there is a bit of nice payment flexibility because it is an interest-only payment, meaning that's the minimum payment you need to make. You could pay extra principal if you want to, but it gives you an option. And maybe the downside these days with HELOCs in an environment where we finally think rates are going to increase over time is that those HELOC rates do move in direct lockstep with federal funds rates. So if you think that rate's going to continue to go up, well, HELOC rates are going to move up exactly commensurate with those. So, Caeli, why don't we come back and talk a little bit more about what you can do after you've already exhausted yourself on your first 10 finance properties? There are better options than there have been previously. You're listening to Get Rich Education. Our guest is Ridge Lending Group's Caeli Ridge. More when we come back. I'm your host, Keith Weinhold.
Are you looking for a roadmap to financial freedom? If so, we have a solution for you. Norada Real Estate is offering a limited number of free strategy sessions to help you get out of the rat race. Learn how you can create wealth and build monthly passive income. To set up a time with one of our knowledgeable investment counselors, simply go to noradarealestate.com. That's NORADA realestate.com.
Cash flow real estate investors, if you're looking for a mortgage loan with a company that specializes in investment property loans, it's Ridge Lending Group. They provide income property loans in almost every U.S. state. Ridge has worked with tens of thousands of investors and homeowners all over the country. In fact, with ethics and transparency, they've helped more people realize their dreams through real estate investing than any other mortgage lender in the country. Get started at ridgelendinggroup.com.
This is Rich Dad, Poor Dad author Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education with our guest, Caeli Ridge, President and CEO of Ridge Lending Group, ridgelendinggroup.com. I don't know about you, but my hand is getting tired from all these notes I'm taking. You know, this is really good stuff. We're really digging into the details here, Caeli. So what does one do after they've so-called Fannie Freddie now? They have the 10 maximum loans as an individual or the 20 as a married couple. What's next?
Yes, great, actually. Keith, I'm so glad you asked me that question. So I talk about this every day with my clients, those that have already reached the 10 or those that are being proactive and they want to know what comes next. We have specialty products, actually a pretty broad menu of loan programs available for our investors that have maxed out their golden tickets. They have options to look at specialty. I'll define that in a second. And then also, obviously, commercial financing, which is a cross-collateralization of debt. That might be an option. I'd like to focus on the specialty stuff. I've been waiting for kind of the shift, a paradigm shift, where the conventional and then the specialty products that have been around for a while started to kind of, the gap maybe starts to kind of close a little bit to where the specialty is a little bit more competitive in interest rate than as opposed to the Fannie Freddie stuff. And we're starting to see that. So I'm really excited to share with your listeners. So the specialty loan products, there's no limit to the number of finance properties an individual can hold. And further, there's no real limit to how many of these specialty loans an individual could secure. The great thing is that the leverage is equal to what you'd find on a conventional loan, 75, 80% loan to value. You have access to 30-year fixed amortizations. And the interest rates, like I alluded to, are starting to come a little bit closer to line with what we're finding on the Fannie Freddie, the agency loans. So if we're at 4.25% today on a conventional Fannie Freddie loan, I would say over the last few years that the specialty products were at least 2.5% higher. Today we're finding, and I just priced this out, hoping we could talk about it before we jumped on this conversation, 5.9 would be a 30-year fixed interest rate on a specialty product with 25% down. It's starting to get really, really attractive for those that want to go past the 10 conventional. I'm very pleased with the way things are kind of moving in that direction, more competitive to the Fannie stuff.
That is really attractive. I'm learning this for the first time myself. That really is attractive. And again, just to reiterate, we are talking about specialty loan products beyond the 10 first financed properties.
Correct. Yes.
That's terrific. Are there points to pay up front?
Yes, we charge similar to how we set our compensation and rates on the conventional side as a company. We charge 2% or $1,500, whichever is greater, on loan sizes 150,000 and below. From 150 to 250 in loan size, origination points are 1.5, and then 250,000 and above, our origination charge is 1%. There's specific reasons that we structure our compensation this way: transparency, consistency, but without getting into all of those nuances, it really boils down to the rate of return. I think our clients can attest, and if there's listeners out there that want to do some comparison, apples to apples, we should be able to yield. Ridge will have the best and lowest market rates the industry is bearing.
That's still not a lot of points for going beyond one's first 10 loans. And yeah, Caeli, I really give you a lot of credit. Just to remind you, the listener, Caeli was last here with us on episode 99. The prior time that she was with us, episode 56, she had her entire rate sheet with all of the closing costs for a typical income property purchase, and I had that same rate sheet here while we were talking, and she broke down line by line just exactly what every loan closing costs is and the prepayments and so on, line by line. So just such transparency there. Anything else that you can tell us beyond these first 10 finance properties that prospective borrowers should prepare themselves for, Caeli?
Yeah, I think that they're going to be very similar. The specialty products are going to be a little less invasive. The analogy that I give for conventional Fannie Freddie loans, in underwriting one of these loans, it's like turning a battleship in a creek. Most of your listeners that have been through the conventional loan process in the last several years are probably laughing right now, and I make a joke just to kind of break the ice, but it can feel that way. On the specialty side of things, it's still a full doc loan. You're still supplying your vials of blood in some ways, but it'll be a little less invasive on the specialty than what they came to experience in the conventional loans that they secured. Other than that, I would say that it's very similar in the overall process. Leverage, like I said, is going to be about the same. 30-year fix is available. Interest rates a little bit higher, but they are starting to come down. But yeah, overall, they should expect somewhere around the same process. One thing I would mention, closing the title ownership in the LLC is going to be allowed on the specialty side where it is not on the conventional side. It's still an individual loan, right? The loan itself will be in the individual name, but closing on a specialty loan, the investor can go ahead and take title in their LLC right there at closing versus what many do outside of closing using a quit claim deed to transfer that title ownership.
Right. So at least in one way, the specialty loan product is easier than the conventional loan product, but surely not every way. Caeli, what about foreign buyers? What are the options for them? We have listeners in 183 nations. What loan types are available to them?
Well, we actually have foreign national loan products. They can expect 75% leverage. They're probably not going to find 30-year fixed money. 5-year ARM is going to be typically the loan term that we'll offer for a foreign national. 7.99 is an interest rate that they'll probably glean somewhere around that. The underwrite is pretty straightforward. It is full doc. We will collect their income documentation from whatever country they reside. It's probably easier to address and send out for those individuals that are interested in investing in the U.S. We have a whole STIP list or checklist of items that we would have them collect and send in. An ITIN number is not mandatory to get our foreign national loan product. It's a pretty decent product, I think, overall. It's a 30-year amortization, if I didn't mention that. It's a 5-year ARM, adjustable rate mortgage. So for those that don't know what that means, it just simply is that for 5 years, the interest rate would be fixed at whatever it's locked in at. And then after the 5-year period of time, that interest rate can adjust based on predetermined rate caps. But the 30-year amortization, I think, is really nice. Most foreign nationals that I talk to, they're more used to 60-month amortizations, maybe a 10-year amortization. The U.S. is one of the only countries on the planet that offers that longer-term amortization, which, of course, really is what keeps our cash flow in place and substantial.
Yeah, so if you can weather the 5-year ARM and you're comfortable with that, yeah, you can get that cash flow with the longer amortization. So just overall, Caeli, back here for domestic borrowers and just anyone else, any other long-term planning considerations that one should think about as they're sort of ramping up to buy an income property, just for example, in the way that they prepare their tax return or just anything else longer term to plan for?
Yeah, that's an excellent question. I would say most specifically, let's talk about the tax return. The Schedule E is more often than not where the rental properties will fall. real estate investors get the benefit of the tax write-offs from the investment properties. Now, without getting too technical and too far down the rabbit hole, some individuals are going to be limited to what they're able to take in the tax benefit until they're able to provide or prove that real estate professional exemption within the IRS tax code. Again, not going into too much detail there, but for those individuals that have reached that level, the goal obviously is to mitigate the taxable income as much as possible. Unfortunately, in underwriting, however, you can't have it both ways. You're either going to pay more in taxes and qualify for conventional financing, or you're going to mitigate your tax implication and maybe not qualify for conventional or other financing.
Right.
So it can be a delicate balance.
That's the type of balance where it's really important to work with a professional. So, Caeli, just overall in the lending climate, 10 years ago, things had gotten unreasonably loose, and all you needed to do was have a pulse to qualify for a loan. So things were unreasonably loose. And then, maybe 6 or 8 years ago, things got unreasonably tight coming out of the mortgage meltdown and the housing crisis and the Great Recession. And it seems like things have been loosening for a few years since they got unreasonably tight, maybe 6 or 8 years ago. So I just want to ask you, what do you see as a potential warning sign? Was a lending threshold that gets crossed probably down the road, not yet? Anything in particular you see as, oh no, that's a warning. I think things are getting irresponsible again. I think that there might be borrowers qualifying for loans that aren't going to be able to repay. Any particular warning sign?
I think we're in a really good place now from, how irresponsible it was prior to, I think the knee jerk was equally irresponsible on the agencies in terms of how difficult they made it, to now. I think that the underwriting guidelines and what is appropriate is appropriate. I think that for default and things like that and warning signs, from a lending perspective, I'm not sure that I see anything that would cause reason for concern. Some of the things, though, as a lender that I'm noticing where I feel like people might have short memories is there are markets out there where you're starting off with an offer. There's an offer on the table for a single family residence of $100,000. By the time the bidding war is over, it's selling for $112,000. Those are the areas that I'm more concerned with in terms of overinflated values and things of that nature, which largely was at play during the crash of 08-09. So that would be my comment there. I think that the loosening of the guidelines has been appropriate. It was necessary, and I think that it's kind of leveled out and it's in a good place.
And there is certainly a balance to strike there, too. I, as a real estate investor, don't want things to get too loose like they were back in 2005, because I'm afraid that I might lose some of my tenants because they're all going to be able to go out and qualify for loans. So I don't want them to get there. Well, Caeli, I've been watching you grow over time, and at this point, you can do loans there at Ridge Lending Group for income properties in almost every U.S. state.
That is correct. There's a few trailing states that we may or may not decide to get licensing in. There's a handful: New York, Alaska, maybe one or two others. But yeah, we have a nice broad footprint, and we can accommodate almost anywhere our investors are looking to purchase and or refinance.
What is the best way for a listener to take action and connect with Ridge Lending Group?
There are a few, actually. They can go to our website, www.ridgelendinggroup.com. There's a very quick and easy intake form if they want to fill out, and we'll contact them immediately. They can call us toll-free at 855-74-RIDGE is the easy way to remember. Or they can simply shoot an email to info@ridgelendinggroup.com, and we will be in touch with them right away and give them whatever information or advice they'd like to have to get started.
Caeli Ridge, it's been valuable having you here every time. It's been great having you back.
Thank you, Keith. I enjoyed it very much.
Yeah, well, that Beyond 10 Properties specialty loan product is one of the more substantial new loan types that I have ever heard about. Wow, let's just review that. So with it, there's no limit at all to the number of loans. It's a 20 to 25% down payment. And she gave an example of a 5.9% interest rate if you put 25% down, a couple discount points there, and 30-year fixed amortizations. That is a great option for when you're beyond 10. Ridge has a lot of educational resources on their website too, a glossary and guidelines and items that you need to line up for pre-qualification. They've got your financial freedom in mind, and most mortgage companies just don't focus on that. Whomever you choose to use for your income property loans, choose a company that has substantial experience with doing specific income property loans over primary residences. That can really help you out, and especially when you're tying up multiple properties in a short period of time, because that's something that owner-occupants just don't do. I'll be back next week to help you build your wealth. Until then, don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.